Kookie, welcome again to the podcast, mate. Here we are sitting here on a Friday afternoon, beautiful sunny day outside, and we're inside talking about the economy.
We're in here talking about the economy when it's sunny. Spring is here. I'm not sure whether spring is here for the economy, though, because we're still going through this slowdown.
Are we in the winter? Are we in the winter of economics?
Well, I hope we're in the low point of economics. I'm not quite sure yet because the economy is still weak, no question.
Well, let's just talk about that first. What does that mean? What do you mean by the economy is weak? What are the markers?
Okay, there are a range of markers and some of them slightly overlap. GDP, gross domestic product, the whole output of goods and services in the economy, only rose by 0.2% in the June quarter. That's really weak.
So what would you like to see it rise by normally?
Normally we get a 0.7 or a 0.8.
Which means the annual run rate is about 2.5 to 3.
2.5 to 3.
Yep.
Our annual run rate's 1.
Currently.
So it's saying that the interest rate hikes that have been delivered from the Reserve Bank since May 2022 are working.
Yeah, so you're not surprised?
Not really, no. The rate hikes have done their job in slowing the economy down.
Well, let's just stop on the GDP for a second, if you don't mind. The GDP is a sum of a number of outputs. So when you say that it's not too bad, that's at 0.2, which is a run rate of 1, you know, if you sort of want to multiply 0.2 by 4, it's sort of, you know, within the range of 1% per annum growth. But which parts of that GDP are growing and which parts are not?
Oh, you've just opened up the can of worms because the weakness, the unambiguous weakness is us consumers, the household consumption they call it. And that is the amount of money that we consumers spend in the retail sector. It's the amount of money we spend on insurance premiums, on dwelling rent. It's the amount of money that on a normal day, everybody listening to this will say, I go and spend, I buy a coffee, I pay my car rego, I do the grocery shopping. All of the things that we buy has fallen in per capita terms for 6 consecutive quarters. It's never done that before. And that's telling us that people are on what we call discretionary items, things that we like to have but don't have to have. Things like holidays, for example. Things like expensive items. We tend not to spend them when the economy's in trouble or our personal finances are in trouble. That's where the weakness has been. The strength is, and Treasurer Jim Chalmers has highlighted this, the reason why we didn't get negative GDP and a genuine recession is the government spending lots of money. It's hiring lots of people.
All governments too, by the way.
They do, yeah.
Not just federal.
Again, this is not a criticism because they're spending the money, and if you took a step back, you think, well, actually, they're spending it on aged care, nurses in aged care facilities. They're spending it on teachers, so educating our kids. They're spending it on infrastructure, like the wonderful rail system that just opened up here in Sydney. You know, that's government spending, and it's not. And of course, there's some waste. You just have to look at
it's
spending
about
money on the Commonwealth Games in Victoria.
But mate, there's some inefficiencies.
There's a lot of inefficiencies, but some of it's actually good. You know, I want my older Australians to be looked after in aged care. I don't want them to be fed crap food and not looked after. No, we're a good country. We need to spend a bit of money.
Mate, I'll be one of them soon.
Yeah, mate, I'm not far behind. So, you know, so some of these things are good, and even things like defence expenditure. You know, there's stuff going on in the geopolitical space around the world. We've just got to be very cautious. So, the question is, what would you cut if you wanted to cut those things? It's pretty hard to find something. But at the end of the day, the expenditure on those things is money being put into the economy by the government sector. And it's the one reason, the one growth area within our GDP numbers. So household consumption weak, government spending strong, business investment was broadly flat, so it was neither here nor there. It was pretty neutral. And then our net exports were tending to start to weaken because the Chinese economy is slowing down. They're buying less of our raw materials, iron ore in particular. And so that's where the weakness was. So we look at where the most severe weakness was. It was in household consumption expenditure because that's over half of GDP. It's actually nearly 2/3 of GDP.
So if we took out the strong government expenditure in the GDP number, we would be cooked.
We'd be cooked. I think it would be about minus 0.3 instead of plus 0.2.
So that's getting into a proper recession.
A fair income recession.
Yep.
And so in a funny way, the people who have got the jobs in the aged care facilities and education and health and all these other things, they're the ones that are keeping the economy with its head just above water. They're the ones that are sort of getting a pay increase, and they're the ones that are sort of offsetting the weakness that we're seeing in private sector demand.
And if I took out, if we took out the immigration build,
Yep.
so normally, so our population growth, organically, that is, people having kids, for example, I think was about 110, 120,000.
About that over the last, correct.
It's a bit
yes.
lower than normal. That's a bit lower.
It is a bit,
It
for
sort of
some
runs
reason.
about 160,000, but it's a bit lower than normal. But if you look at the immigration numbers, they were quite high.
Yep.
And they only came out like a couple of days ago. And so if you took that out, the immigration, the extra immigration that we are seeing currently relative to what we would ordinarily have, and it's around about probably 300 more than we would normally get in a 12-month period. And if you took out the government spending, we probably would be in a fairly solid recession.
And even a deeper recession, yes. The population growth through immigration, in quarterly terms, it's about 0.5 or 0.6 in terms of population growth. Normally it's about 0.2.
Right.
So if it was back to 0.2, you're losing 0.3. Let's be generous in our assessment. So on that score, we'd be at minus 0.1. So the fact that we've got this very high level of immigration, immigrants do spend money. They, they need a house. They need to eat. They need to get a Uber. They need to, they spend money, and they work too. So they're actually adding to the economy, and that's another reason. The two reasons why we are not in a deeper downturn: immigration and public sector spending. And both of those things can't go on forever.
No. Well, especially politically. So, okay, so you, in terms of your assessment of the economy, GDP is sort of going okay, but is responding the way you would expect to respond, given that we've had high interest rates for quite a long time. What else?
It's weakening a lot.
Other markers?
A couple of other markers. We had the labour force numbers just yesterday. We're still getting really strong employment growth. So
What is that? Like, I don't understand. Like, if the economy is sort of weak, how are we still only at 4.2 unemployment? Is there something wrong with the calculation, or what?
there might be. But interestingly,
I've often
employment's
wondered.
still going up because of the population growth, but we have had an increase in the unemployment rate from where we were a year ago. You know, month on month, these figures are all volatile. They're just a survey done by the Bureau of Statistics. A year ago, the unemployment rate was 3.5%. So we're now at 4.2. So it has crept up. You know, there's been a few ups and a few downs, but generally it's zigzagging
Upwards. So the trend's up.
So the trend is up. There's no doubt about that. And when we look at things like job ads, job vacancies, they're all tilting down and saying that the
But
unemployment
they've been
rate
for
will go up.
ages, mate.
They have.
And it hasn't really reflected yet. I mean,
It has a bit. No, it hasn't.
not much.
One thing when the RBA governor, so don't take my word for it, we'll take Michelle Bullock. The RBA governor was asked this very question at her last press conference, and I'm sure on Tuesday at the next board meeting she'll be asked about it again. She'll be asked, why is the labour market so resilient? Her answer was actually really illustrative, I think, and something that we should consider and everybody listening should consider.
Let's talk about it then.
It was called, the economic term is labour hoarding. So it sounds like a strange thing for bosses to do. But it's a phenomenon that when the economy slows down, if you're a business owner, your business is slowing down as the economy weakens. You've got 10 staff, for example, and you think, oh, gee, I don't really need these 10 staff anymore, but I'm not going to sack them yet because I'm not sure whether this downturn's only temporary. And of course, it costs a lot to hire and fire people. So I'll just ask them to work a few less hours. No overtime, guys. Can you just sort of take your annual leave now?
No pay rise.
No pay rise.
No bonus.
This sort of thing happens. So the firms hold on to their labour and only sack people. Sounds a very harsh thing to say. And the unemployment then only goes up when they say, look, I can't afford to keep you anymore and I've got to sack one or two people.
When do you get that? How do we know when we're getting close to that point whereby we no longer hoard our labour?
It's when there's a clear hit to company profits. And company profits, because mining's not a very big employer of people and it's a very volatile part of the ASX, the stock market. Company profits are sort of trending down a little bit. Because of the weakness in the economy, of course, so firms are not making as much money as they were previously. If we were to get a further downdraft in the next quarter or two, you'd expect to see the unemployment rate to go up. So the Reserve Bank is forecasting unemployment rate to get to 4.4% in the next couple of quarters from 4.2.
It's not huge.
It's not a huge. We're almost there. It's almost a rounding error, you'd say, in economics. The question will that be the peak? And a lot of people out there, I look at all the market economists, the very good people that the banks employ. I think without exception, they're all saying it's going to go higher than 4.4.
The general view is
and a few
closer
people,
to
4.75, 5 and a quarter. As soon as we get towards 5, let alone hit 5, let alone exceed 5, then that's when the Reserve Bank has a real problem. That's when we start getting serious interest rate cuts. But we're not there yet, and I think that.
How many months of high since it is? How many months is it since our last rate rise?
It was in November last year.
So it's
sort of up to
10 months.
10 months.
So we've had 10 months of these high interest rates.
Of no change in rates. In November they hiked them to 4.25.
But the unemployment number is still only 4.2.
Correct. Yes, correct. And the other thing that sort of
it's perplexing me. It is perplexing because we are seeing the household consumption numbers come off quite dramatically, right?
And retail, which is a big employer of people. As I said, mining doesn't employ a lot of people. Mining, a boom and a bust, it doesn't employ that many people. Retail, which is really labour intensive. Retail includes your restaurants and cafes.
Yep.
The barista, the chef, the dish pig who washes the dishes. A whole lot of people involved in that. That's where the weakness has been.
But and it's quite a big weakness. So I don't understand why, if they're a big employer, why are we still at 4.2? And we had big, we've had big immigration as well.
Mark, I'll come back to what we were saying a couple of minutes ago. People are moving into aged care, healthcare, education. That if you look at
the government's employing them.
The government's employing them, correct. So, in fact, I think it might have been Alex Joyner, the fellow from IFM Investors.
Yep.
Really good economist. He pointed this out, so I'll give him the credit. He pointed out that in the labour force release, what was termed market-based employment, which is basically private sector employment, has only just crept up a little bit over the last couple of years. So if that was the only labour market indicator, the unemployment rate would be at 5% already.
Right.
Public sector employment, teachers, police, aged care, all those things. That has been where I think, I don't want to misquote him, but my recollection is about 80% of the new jobs that have been created over the last year have been public sector. Normally, in normal times, public sector creates about 15, 20% of all the jobs that are created.
So that's
as the economy grows, we do need a few more police, we do need a few more teachers. 15 to 20%. Now it's 80%, and only 20% of the jobs are coming from the private sector. And so, the public sector doesn't respond to interest rates at all. It's the private sector that gets hit by interest rates. So the reason why you're perplexed, and I'm perplexed about a 4.2 unemployment rate, is that the government is employing the people who are leaving private sector employment, and the retail trade in particular.
So maybe Dr. Jim is a really good economist.
Well, he's meeting. This is the really interesting thing.
In an unusual way.
No, but he's meeting his election promises. Okay, we are all critical of governments when they break their promises. And fair enough. If you go to an election, you promise something, and you break your promise, you deserve a kick in the tail. Fair enough. To their credit, they promised that they would put a nurse in 24/7 into every aged care facility, and they have. That was, if I remember correctly, 40 or 50,000 nurses that had to be employed to meet that objective. So they met their promise. Education, NDIS, all these other things which employ a lot of people, they're really labour intensive, is where a lot of the other employments come too. So the question is, and this comes back to where, the size of government's getting bigger, the budget, which was in surplus for 2 years, is now in deficit this current year. If you want to get a balanced budget and to allow the RBA to cut interest rates, because that's the other debate. The only reason the RBA is not cutting like the Americans, like the Europeans and the New Zealanders and the Canadians is because government spending so strong. What would you cut? And I mean that in a political sense. Would you cut your defence spending? Maybe not. Would you cut your nursing and aged care? Maybe not. Would you hike taxes? Well, nobody wants to pay more tax. So this is where the government's got a real dilemma politically explaining that to the people, and that's why they're behind in the polls, to be frank, because they haven't explained it terribly well, to be honest.
And do you think they're behind in the polls because of their economic performance, or they're behind the polls for other reasons?
Look,
I know it's a little bit outside of our ambit, but I'd like to hear what you've got to say.
Look, I think it's the weak economy. People get pissed off, to be blunt.
It is number one on the surveys at the moment.
Yeah,
cost of living.
Cost of living.
Yep.
And people, we consumers are smart. Australian consumers are really smart. They're really savvy. They know when their bank account's under financial stress, either through rent going up or so much money being sucked out of their bank account every month on their mortgage repayments as interest rates have gone up. And they can see their electricity bill. They can see their insurance bill. They can see the cost of their grocery bill, which, that high inflation problem was very much about that sort of stuff. And the government, the incumbent government of the day, John Howard found this out a few years back, whatever. Various governments have found this out when the economy's in trouble, people blame the government, whether it's their fault or not. And I'm not saying it is or it isn't at this stage, but they blame the government. So that's what Albo and Jim Chalmers have got to deal with politically, because even if some of it's their fault or not their fault, or Jim's a miracle worker because he's employing all these public servants or public employees, people at the end of the day thinking, God, my interest rates are still really high. Oh, when's this rate cut coming in? It hasn't come through. Oh, rent. Oh my God, I'm still paying so much. My insurance bill just came in. It's giving me a real pressure on my finances. Oh, the bloody government, I'm going to blame them.
But it's a bit of a catch-22 though, isn't it? Because the more the more the government looks after, let's call it the public sector, the public employees, and puts money into their hands, and they then go and spend it in the economy, the more they have to put interest rate, or the longer we have to hold interest rates high, because the economy tends to perform better than it really is.
Yes, there's an element of truth in that.
And which one is it though? Which one? I mean, in a behavioural economic sense, which you're an economist, which one affects people more? Is it I feel really good because I got a good job and I'm working, I've got good hours and I'm getting good pay, and I'm one of the few, because I'm in the public sector, I've got wage increases. I'm one of the few people got a proper wage increase. Is that prevail, or does it? No, hang on. But my cost of living has gone crazy. And I'm paying higher insurances on my house and my car and everything else going on around me, and everything my cost of living is much more expensive. Yep. Which one prevails politically? I mean, you're around the Gillard gaze. What's
cost
the deal?
of living hits everybody.
Right.
Everybody, whether you're the public servant, the tradie, the shop owner, the highfalutin, whatever, lawyer, earning truckloads of money, the cost of living still affects you.
Yeah.
100% of the population pay more for their insurance and school fees and all these other things.
Yeah, and by the way, if you've got more assets, you pay more too.
Correct. And it's only 10% or 20% of the population that've got the secure, safe job with a decent pay rise, as you said. So the cost of living impacts 100% of the population. Pensioners, young folk, young people at uni, getting out of uni with their HECS debt, and they're sort of thinking, oh my God, rent's gone up. It hits everybody. Whereas the job that you might get in an aged care facility with a nice 15, 25% pay increase, great, there's not enough to offset the fact that the cost of living hits everyone. And that's why, apart from the Reserve Bank, the government's hoping like hell that inflation rate falls and falls quickly, because the election is only, 8 months away now.
Yeah, so just on that, do you think the RBA, the current government is sitting there hoping to themselves, we need a rate reduction, an RBA rate reduction before the next election?
They're hoping for it, yes. And do they need it? Well, Jim Chalmers, to his credit, and I'll give him credit for this, since he's been Treasurer, has always said the RBA is independent. Now, there's a debate whether he's saying the right thing, but, he does not, like Keating said, I've got the RBA in my pocket. Remember that?
Different terminology, but same thing.
And, whether that was true or not with Bernie Fraser back in the day, who knows? But Jim has said the RBA sets interest rates. They do their job. I do my job on government taxing and spending. They do it on interest rates. We talk, as they should. I hope they do, gosh. But at the end of the day, the Labor Party would really love to see a couple of rate cuts before the election, because it would be this sort of situation where rate cuts, people think, oh, thank goodness, I've got a couple $100 off my monthly repayments. And of course, the discussion amongst us economists would be, there's probably more to come. So that, because there's not only going to be one or two cuts. When the cutting cycle starts, there will be multiple rate cuts coming through. And so politically, they could sort of get on their high horse and say, look, we had a problem, we had high interest rates, we had high inflation, but look, we've got through that problem, so vote for us.
Yeah. Well, we're not as bad a manager as you want to say.
Yes,
yeah.
and in fact, we've got through this difficult time. And whether that wins votes or not, I don't know. I'm not into that space, but you can sort of see what they're hoping to achieve.
So let's look at apart from GDP and labour market, which came out today. GDP. Let me get it right.
Labour market was yesterday.
Yesterday came out yesterday.
Yeah.
So, what are the markers? What other bits of data have we got that are hanging around before the next meeting?
Inflation. And when's
that come out? When's the next one?
In fact, we got the next one out this Wednesday. The monthly
inflation.
But
it's after she meets.
Correct. It's after the one, and the big one with the October board meeting will be the September quarter inflation numbers. Now.
Yeah. So what's the talk now around Wednesday's inflation number, CPI?
Well, even this monthly one is really interesting because I get all the banks' research and I really value it. They're smart economists in the financial markets. But just the two that struck me were both Westpac and Commonwealth Bank economists, their economics teams. They're saying that the effect of this subsidy on electricity prices, that $75 a quarter that came through in our bills this quarter.
Post the last budget.
Yep, which was a government policy initiative and plain and simple to ease cost of living pressures, is going to see electricity prices drop 16% in the month. That will shave at least 0.5, 0.6 off your monthly inflation rate.
But for the month.
For the month only.
Yep.
We've got a 0.6 dropping out of the run rate from a year ago. So the annual figure is going to be, hold on to your hat, 2.7.
Yeah, so 3.8 down to 2.7.
The target band.
That's the headline.
Distorted by the headline will be distorted. Yeah, it will be distorted by that insurance. The electricity subsidy that's coming through.
But for the month.
For the month, and it'll continue for 12 months until that subsidy disappears in 1 July 2025.
But that's not a quarterly. That's not going to contribute too much to the quarterly run rate.
It'll help drop the run rate down to under 3. We'll have a headline figure under 3. Now the question is, I think we discussed this last time, is that the RBA know that it's a distortion.
Of course they do.
And I'm 60-40 on it. Yes, it's a lower cost of living. It's a good thing in that people are paying less for electricity. If the inflation rate comes in at 2.7 for the month and for the quarter, wages at 3.5, it is a true cost of living measure because I'm not paying as much for electricity because of this subsidy. Fine. But from the RBA's perspective, and this is where there's strong element of truth, is that the RBA is setting interest rates to adjust how much you and I and everybody listening spends in the economy. They want us to trim our spending so that businesses don't increase their prices, maybe lower them, so that inflation comes back under control. The government could do all sorts of things on beer excise and petrol excise and get inflation down. That's not how you do it. You manage demand, spending in the economy to meet inflation, and that's why the Reserve Bank will look at what we call the trimmed mean inflation rate, which takes out the extremely volatile items, and of course electricity will be minus 16%, a very volatile item. And they'll look at this underlying or core inflation rate, and that's probably still going to be in the low 3s, 3.25, 3.4.
Still an improvement though.
On improvement, it's trending down. As Michelle Bullock, I'm sure will say, it's trending down, but we'd like it to fall faster.
Yeah. And more.
We'd like it to fall more and quicker and sooner.
Yeah.
And until it does, we're on hold.
So CBA was predicting a rate reduction this year. I think they're the only bank out of all the majors to be predicting that. Are they still at that territory?
They were saying November, but Garth Aird, who's the chief Aussie economist, excellent too, by the way. Sorry to give all my economist mates an uptick, but they're good. They've pushed it out to December.
Right.
They're saying November's too soon. The reason why they've moved it to December...
Is there a meeting in December?
Yeah, about the 7th or 8th of December. There's only 3 more. There's one...
October.
24th of September, there's one late October, and there's the last one in December. So there's only 3 more.
So we don't have the Melbourne Cup Day meetings anymore, do we?
No, I think this one might be about Melbourne Cup dates in early November. Don't
You
hold me
have
on
one
this.
on the 2nd of November, or the first Tuesday in November every year.
Yeah, we used to.
And that was always important because they always either put rates up or down. Like for
They almost always did it.
always. I don't know why, but they just generally speaking do
Oh,
something.
usually because they got the quarterly CPI a week beforehand. And that was an
We'll just
important
check with our
indicator.
production crew.
We've got 23rd, 24th September, 4th to 5th November.
Oh, so it is 5th of November.
So
Melbourne Cup Day.
okay, Melbourne Cup Day, great.
So anyway, CBI have pushed it back one meeting,
Right.
Because they're of the view that that resilience in the labour market that we were talking about a minute ago was important to them, and that maybe, just maybe, some of these measures of income tax cuts might be having a lagged effect in terms of spending. The electricity subsidies that we were mentioning in terms of the CPI, that's $75 in people's pockets that they may spend.
Yeah.
So they're still saying that the economy is still weak, but the RBA want to be rolled gold certain that weakness is continuing, that the inflation rate's falling. In December, they'll have the next quarterly GDP number. As you were just sort of saying, it was only 0.2 last quarter. Too early to make a forecast on what it might be this time, but it's not going to be strong. Yeah, retail sales are still pretty sluggish. Building approvals are still pretty ordinary. Might just be saved again by government demand.
But we might also get the the Black Friday phenomenon.
Sales, yes.
There are a few weird phenomena that exist around that period, which sort of skew the numbers a bit, particularly in retail.
And they did last year too.
Yeah,
That's why they had a
100%.
rate hike in November, because they
that.
saw the Black Friday sales.
Yep.
Like, oh, gee, the consumers come back, so we better hike rates again.
Which has become like the Christmas Day shopping day for Christmas.
Brought forward about 6 or 8 weeks. Yeah, so it's a really interesting thing. And by the way, by then, of course, they'll have a lot more information on what's happening globally. The Americans only cut rates this week, 0.5 percentage point. There are more cuts priced in. So I dare say the RBA would love to see, the Fed going to cut another couple of times. Bank of England were on hold this week, even though they've cut previously. So will they resume their cutting cycle again?
European,
Canada, Kiwis, they've all cut rates at least once.
Are they still cutting though? I can't.
They're still cutting, but they're talking of pauses in most of them. There's just one or two cuts, just as what we might call insurance rate cuts against a hard landing.
Yeah.
So they want that, like our own Reserve Bank. Here's a couple of rate cuts, just to take a bit of pressure off the economy. But we're going to pause now until we get absolute confirmation that inflation's back under control.
So just in terms of summary of that, I think that's a really important point you just made. Using the word hard landing, I think it's fair to say that no government wants to see a disaster. So they're not exactly sure what that means or how that occurs. So they're saying, in the case of the US, we'll give it a 0.5 point trim, 0.5 percentage 50 basis point trim, I should say. Yep. We'll give it a 50 basis point trim, which is a good whack. That buys them a bit of insurance. Before they were trying to buy insurance against the economy getting out of control, like growing too hard. Now they're trying to buy insurance for making sure it doesn't get too weak.
Correct.
And it looks like UK, ECB, the European Union, and Canada went and. I wouldn't worry about New Zealand. New Zealand did as well, but they all went way ahead of the USA. Do you think
Canada's gone 3 times, by the way? Yeah.
And do you expect that that's how she would react when the time comes?
I think so too, and that's the really interesting thing about some of these rate cuts. And remember, the 50 basis point from the Fed was from a 5.5% starting point. We're not at 2 and cutting to 1.5. There's a bit of fat there, if you like, for the first couple of rate cuts. But we've had this discussion before. I'm pretty sure we talked about this last time. In the discussion about rate cuts around the world, including here in Australia, do not think that we're going to go back to where rates were.
100%. Yeah, correct.
We are not.
No.
This debate about rate cuts, up, down.
And by the way, the Federal Reserve said exactly that.
Correct. Everybody's saying, every central banker who's spoken about rate cuts has said the same thing. So all we are talking about in this rate cutting cycle is whether we cut, and this is in total, 100, 150 basis points, 200 if things are worse than expected. But that's it. So the case in Australia, if, and it's a big if, we got 150 basis points of rate cuts over the next 12 or 18 months, we'd be down at 2.85%. 2.85%.
I just can't see it.
We might only get 100, so we're down to 3.35.
Yeah.
We're not talking more rate cuts because the structure of the economy, the structure which is driving inflation, And even this lower inflation, great news. I'm delighted to see inflation coming down and all the rest of it. But we're not going to be moving to 1% or 0% inflation. We'll be hitting the targets, that's great, but not massively overshooting that we require cut after cut after cut to get inflation back up. We're going to hit the targets, they're going to cut, they're going to hold, they're going to pause, So all we are talking about with this rate cutting cycle around the world, but also here, is, 100 points and maybe a smidge more if something goes wrong.
So I like to refer to this as the interest rate tango. It's sort of a little move here, then we stop and have a look in each other's eyes, and then we have another move over here. Because it really
and
is.
And then the music stops.
And it's going to be like the interest rate tango. It's going to be like a tango.
Oh, and I think, and the other thing, Mark, we remember this, and it's important that everybody listening remembers this too, that the COVID period and the period after the COVID lockdowns and all those rate hikes, that's not usually how central banks move interest rates.
No, definitely.
If you look at the period, I'll even talk about a 19-year period from the year 2000 to 2019. Go to the RBA webpage and look at the number of times rates go up or down versus the number of times they're steady. We often go a year or two with one or two moves. Whether it's up or down doesn't matter. The Reserve Bank does not like to adjust interest rates. They only do it when they have to. And when they have to, fine, they'll do it. They'll cut, they'll hike, they'll do whatever they do. Normally they do 2 or 3 and then they'll pause for a year. So your tango analogy, we've done a couple, let's just sit back and see how they're working.
Yeah.
Let's just see if this is enough medicine to meet our growth target, our unemployment target, and our inflation target. And if they find out, we haven't done enough, they'll do another couple more in a year's time. And so that's why I think we're getting, and we were saying before that the last move in Australia was November last year. So what's that, 10 months?
It was Melbourne Cup Day last year.
Yeah, we could well go another couple of months before we get our first cut here, whatever. And then we might get a couple and then nothing through the remainder of 25, 26. We'll see what happens. I don't want to forecast that too far out. But we're not going to, barring some awful event or something strange happening in the economy or geopolitical event, they're just going to tweak them down, hold them. They prefer to keep rates steady than to put them up or down.
So how important then is the Jerome Powell Federal Reserve 50 basis points reduction of their interest rates last week?
It's important for us.
Yeah, how important though? I mean, what do they do?
It's not the dominant thing. Look, we don't move rates in lockstep with the US.
No.
But, and it's a really important but, if the US is cutting interest rates, using this example now, it's because the economy is slowing down, inflation's falling, they're worried about the labour market. And Jerome Powell, the Fed chairperson, said this quite explicitly, we're doing this to make sure that the unemployment rate doesn't go up too much in 2025. We're starting now with a 50-point move to make sure that the economy is not even weaker next year. The US is still the world's biggest economy. It's still bigger than China, using different measures.
But especially at the moment.
And it's a dominant part of global capital markets, stock markets, bond markets, everything. It's why we wake up in the morning, what happened to the US stock market? What happened to the US bond market? It matters. It's not just for fun that we do that. If they go belly up, it's a disaster. If they go well, we get dragged along on the coattails. So Jerome Powell and the Fed cutting 50 is big news. It's saying that the Fed is willing to be pretty aggressive, because it was not the consensus view, by the way. They only thought they'd cut 25. The Wall Street economists, I think the vast majority said 25, and we'll see how they go, but they went 50. And it's saying that the US economy, if it weakens, will have big implications for the global economy. And of course, we've got the US presidential election to throw into that mix too. Heaven forbid, who knows what happens there. But the US economy, by taking this pro-growth stance, and that's what it is, aggressive rate cuts are beneficial for the economy in 6 to 12 months' time. And if the Fed cuts a couple more times late this year and in the first half of next year, the US economy will be very strong in 2025, 26. US economy is strong, huge driver of demand for consumer goods, huge driver of demand for metals and materials and energy, and that helps the global economy, helps the Australian economy. So we don't move in lockstep, but if they keep cutting and cutting and cutting over the next 3 or 4 months and we don't, something's gone out of whack.
So if the US Federal Reserve has, which they have, they've cut the interest rates in response to where inflation is. How important is that to us in terms of our imported inflation into Australia?
Yeah. When we look back at our inflation problem, I'll start by that. A lot of that was imported items. The supply chain problems, the price of timber and oil and all this stuff went up. With freight shipping costs, nothing really to do with Australia.
I remember Bill Evans saying,
Yeah.
we talked about the cost of timber imports.
Yes, it was extraordinary. That's
Yeah.
why the building costs went up. The cost of construction
Yep.
items went up massively.
In Australia, yep.
Yep, and that was nothing to do with Australia.
Yep.
So we imported it. So on the way down, we import falling inflation.
Good.
Yes, and the interesting thing about that market, just in the last day or two or three, the Aussie dollar's back above 68 cents, I should say, which also adds to the downside risks to inflation because everything we import will be a little bit cheaper as the Aussie dollar goes up. So that's an important part of our path to lower inflation, if you like. And okay, it's only been a couple of days. It's got to stay there for a period of time for it to really impact on what importers pay for their goods and services. But this whole process of the Fed cutting, of US inflation rate tracking lower, in line with Chinese inflation tracking lower, and inflation around the world. The oil price is weak, commodity prices down. Iron ore, which was $140 a ton, a really important export issue for Australia, is now $90 a ton. So the iron ore producers are still making money, but not as much. That has implications on tax receipts for the government, implications on national income. So if you're a shareholder in a big iron ore producer, you've lost money this last little while.
And you're going to get less of a dividend, which means you've got
Correct.
less money to spend.
Correct. So it does matter. All these things. So gosh, the economy is one of these amazing. So that's why we talk for so long every time we get together. There's so many moving parts to this economy. It's nice to keep it simple, but occasionally things pop up. And the US doesn't cut 50 basis points every day of the week. In fact, by the way, that was the first 50-point cut. They've done a few hikes of 50 in 16 years.
Wow.
People don't realise. I didn't realise until I heard it.
I didn't know that either. I mean, I for some reason I thought they might have cut.
They've cut 25s. They've hiked a couple of 50s, but it's the first 50-point cut in 16 years.
Well, does that sort of indicate
That's the global financial crisis, of course, when Lehman Brothers was going belly up.
But does it indicate to you they know something about inflation that we don't know?
That's the implication, yes, and maybe they do. The Fed in the US is very different to our RBA. They've got really active state Federal Reserves. There's St. Louis Fed and the Kansas Fed. They've got central bank operations or subsets or subdivisions, whatever, in all of the other states, and they all monitor. They don't control interest rates, but they monitor how's my state going. So it'd be a bit like having the Reserve Bank of New South Wales.
Yep.
Just pretend. And they wouldn't set interest rates, but what they would do would be monitoring the economy. What are the big New South Wales small companies in New South Wales telling us about labour costs, about prices, about economic activity, forward orders, all this sort of stuff. And that's where we get this thing in the US, gosh, without getting into too much detail, called the Beige Book, where all these state Federal Reserves report into the central body every month, I think it is. How's the economy going? What's this Beige Book saying? Oh, economic activity is weak in the south of the US and it's strong in California and it's weak everywhere, or inflation's coming. So they bring together anecdotes. So in a funny way, it doesn't get the attention that other economic data does because it's a bit touchy-feely. It's sort of like, it's not hard. I can't say there's a fact that the inflation rate's falling. They'll report the fact that the bulk of companies are telling us price pressures are easing. They can't say that the inflation rate's falling. So it's not a hard number like an official inflation number, 2.5%. That's a hard number versus the anecdotal evidence.
But that's interesting. I don't know. I just got a little bit suspicious when I saw it.
Yeah.
I thought because I didn't realize it was 16 years, but I knew it was a long time.
Yeah.
And I thought that's a pretty big number to kick off with. I mean, it's a very big bet.
And when the inflation rate's still above the target.
It's above the target.
It's falling towards it, so don't get me wrong.
But it's not 1.5.
No, it's still 2.
Yeah, it's 2.5.
2.
Yeah.
So not quite there. And the unemployment rate, same as Australia, 4.2%.
Yeah, so
it's gone up a bit, but not much.
So it's not like
So
unemployment
just
is 6 or
No, like
which,
in Canada.
like in Canada and Europe.
Yep, which is why they've cut more than
Yeah,
our
the US.
friends in America. Yeah.
Yeah.
So it's a bold move. Yep.
Yeah, well, if
bold move.
nothing else, it's a bold move. It may well be indicative of something worse than we would otherwise expect. But I guess we're never going to know until they have the next meeting. When do they meet?
The next meeting's in middle to late October.
Right. Okay.
Sorry, it's about 7 weeks from the meeting this week. So it's late October.
And how important is our Australian dollar being, relatively speaking, stronger relative to the US dollar? How important is that for us in terms of our inflation control?
I wouldn't want to overstate it. There's a couple of things. It has to be there and be there for a long time.
Right.
A spike up, just say we got to 70 cents in the next couple of weeks. If it goes there and then comes back to 68, it has no effect.
Right.
It's got to go up and stay up.
Right.
If you're lucky enough to have done your trade at 70 cents, half your luck. It's got to stay there to embed the lower cost of imports. So it's not just a one-off, one-hit wonder. If it gets to 70, 72, 74, whatever, not my forecast, by the way, but if it were to do that, it would have important implications. But the fact that it's now breaking out of this range, the Aussie dollar until now has been remarkably stable. It's been 63, 64, 65, 66. Now we're through 68, and the discussion is that if the Fed does cut more and the RBA is stubborn in its decision on interest rates, and a few other things happen, the Chinese stimulus gives a perception that China's going to recover next year or whatever, we could easily be at 70 cents for the first time in a couple of years, and that would start to have implications for what the Reserve Bank would be thinking.
Righto, mate. Well, let's look at our board.
Okay.
Let's go through it.
Rightio.
Because I think we've pretty much done the job, but let's go through each individual one quickly.
I'll rattle through this quite quickly.
Rightio,
Mark.
What do you got for me?
The checklist. And I'm going to be putting a number of these markers way over to the right-hand side, which is neutral to easing. So GDP.
I'm looking forward to that.
1% annual GDP, 0.2% quarterly GDP, not good enough. I'm sorry, we should be growing stronger than that. Inflation, I'm already putting to neutral because we do know that headline versus underlying thing that we spoke about. Headline inflation's great. Underlying still stubborn, but it's neutral. It doesn't mean we have to hike again.
That's
but
the first time.
First time in a couple of years.
Yeah, that's the first time I've seen it over there for a long, long time.
Labour market I'm going to keep in neutral. I think last time I moved a little bit more towards easing, but we've had that resilience in employment growth. It's certainly not tightening because we know that job ads are falling and there's probably more weakness out there, but it's just neutral. Wages, neutral again. Quarterly wages, in fact, in the next 2 or 3 weeks, we get the next wages number, really important. But wages growth is already starting just to come down a bit as the economy weakens. Again, we're not going back to where we were pre-pandemic with 2% wages growth, but more, instead of 4.5, it's going to be 3.5, 3 point something. So that's the Goldilocks. Not too hot, not too cold, just right. International economy, I'm putting that in easing. We just rattled off all those countries that are cutting rates. They're not cutting rates because their economies are strong. They're cutting because their economies
And what's
are weak.
interesting about this is the first time we've been able to say that the US is cutting.
Yep.
And that means everyone's in alignment.
Correct.
Europe, UK, Canada, United States, and China and our mates in New Zealand.
And our mates in Kiwiland. House prices, we haven't discussed them for a little while. They're cooling. Melbourne, Hobart, Darwin and Canberra are really weak.
Yep.
Sydney's slowing down. There's a lot more listings coming on board. Adelaide, Perth and Brisbane are still strong, but even then the rate of increase is just starting to come off. But the RBA would not be worried about house prices on the upside or the downside, so neutral. Retail sales, we mentioned, shocking. The household spending, we mentioned, dismal. Consumer sentiments, weak as water. Building approvals, we are not building enough houses, Mark. We've had this discussion for years. I remember even a decade ago, we need to build more bloody houses. And we're having trouble getting councils to approve the land, builders to build them. The government's struggling to get, don't talk to me about the Greens blocking this project in the Senate. Okay, it wasn't the magic wand that was going to fix housing, but it was another 40,000 dwellings. The housing crisis isn't going to be fixed with one single issue.
And it's not just here, by the way.
It'll be a number of issues.
The same in America.
It's extraordinary. It's very poor.
It seems to me that this is a phenomenon that exists nearly around most of the developed world right now.
It is. We've got a shortage of housing. Correct. Yep. The Americans have got a shortage everywhere. We need to build more
It's
housing.
not just because of immigration. We have a shortage of housing per se.
It's household formation as well as part of the issue. Business investment's okay. Not, again, that's in the groove, so there's a bit of capex going on, so it's not in the easing column, certainly not in the tightening column.
But it's not decisive one way or the other, business investment.
The RBA would look at it and think, that's okay, what are we worried about?
Yeah.
Business confidence, I'm putting that to slightly easing because the NAB survey came out a couple of weeks ago. Business conditions and business confidence tilting down again.
Wow.
Profit expectations, we were talking about profits before, tilting a little bit lower. So just starting to get a little bit of a hint on business confidence softening a bit too much.
But what's crazy about that is that the stock market's on fire.
Stock market's at a record high. Yeah, isn't that crazy? Anyway.
Anomalies.
Commodity prices. I'm putting that in easing. Look at the oil price. Everybody fill out your car this weekend or next weekend. It's good, depending which city you're in and, which suburb you're in, the oil price is a bit fickle. But, oil prices down, iron ore prices down, copper prices down. It's saying something. You mentioned stocks booming. I'm putting that. The RBA doesn't target the stock market. The fact that we're a record high, they'll be thinking.
Well, except wealth effect.
Yes. Unless there's a crash. It's more when there's a crash they look at it. If it sort of grinds up a couple of percent every couple of months, they'll be happy because there is a wealth effect. Yes.
But probably not enough because it's sitting in super. So it's probably not enough to drive the economy.
Correct. A lot of us can't get our hands on it because it's stuck in our superannuation accounts. And current rates, I'm putting them in easing because they are restricted. The RBA even acknowledges that 4.35 is restrictive. We're not talking about an interest rate discussion where the cash rate is 0.1. It's already 4.35. So you look at our scorecard here.
So we've got seven in the easing and 6 in the hold.
And none in the tightening.
None in the tightening.
And I defy anybody to send in to you guys on the podcast, whatever.
Warren Hogan.
Warren, what is in the tightening category? And
which one, Steve?
Which part?
Which one do we need to tip you over into easing? Which one?
It has to be inflation, has to be confirmed lower, but with a very close watch on the labour market.
So if labour market goes to 4.4, let's just put.
If we come back in 2 months, we've got 2 more readings on the labour market numbers and 1 more reading on inflation. If we're at 4.4, I would be putting that in the easing column. The inflation 2.7, you'd sort of it'd be gravitating that way.
So, but do you think inflation needs to get down to 2?
No. And the RBA
so if it gets into 2.5, headline.
The RBA will be thrilled with that. They'll be looking at the trimmed mean. If the trimmed mean gets to 3.0, at the same time, headlines at 2.5, with the unemployment rate at 4.4, that's the rate cut.
That's Goldilocks.
That's the target being hit. I don't want to say mission accomplished, but it'll be mission accomplished for the RBA. We can trim rates a little. And again, you heard what we said before. We're not talking mass rate cuts here. We're only talking a couple. And to just take some of the pressure off the economy.
Do you think the RBA will go 10 basis points or something like that? Do you think they could do something like that? Or do you think they're just going to go back to the old traditional process?
I think we just do 25s. Yeah. Look, I like the concept of a 10, just as a signal. We've had this conversation. Taste. Maybe this is for the next time we get together because we know this. I've observed this in a lot of the stuff that I've done. A lot of the monetary policy and interest rate issue is not so much the cash flow effect of a rate move, it's psychology.
Yeah, the move itself.
They've cut rates.
The move itself.
And that's the headline news. It's spoken about in the media for days and weeks and months. They've cut rates. So that, what do we call animal spirits, I think as John Maynard Keynes used to call it. It's not just the cash flow. Okay, saving a bit of money on a rate cut's fine, but what are they saying? How do I feel? There's a rate cut. Phew. Even though it might only be a few bucks a month. 10 basis points? That'd be a worse thing there to do.
Well, it gets it to 425. It puts nice. You know what I'm saying? I quite like that.
I like it too.
I don't know what it is. I don't like the 435.
35 and 410 and 385.
No, forget it. I don't and it gets us back into some sort of better cadence. I don't know why, but it just mathematically seems right to me. Well, mate, so the meeting on tomorrow, what do you think is going to happen, mate?
No change. Look, you never say 100% certain, but they're not going to change. It's what she says. It's what the governor...
No change, but what are you looking for her to say? That we're going to hang off.
I'm looking for her to soften her views about a rate hike. I think she can come out and say we are not going to hike. Remember the last statement she said, we did discuss rates on hold and we also discussed the possibility, however remote, of a rate hike. I think she'll get rid of that and acknowledge that since that last meeting, that we've had the world economy, US in particular, slowing down, that we've had a disappointing response to the tax cuts with the retail sales numbers and consumer sentiment, consumer spending still being as weak as water. They'll come out, or she'll come out and say, look, we're confident that headline inflation will be lower, and we welcome that, but we are going to look at trimmed mean. We're not ready to adjust interest rates yet, but we're watching the trimmed mean inflation rate and the unemployment rate for the signal on our next move.
And what are the money markets betting?
Money markets are betting a very small possibility of a move tomorrow. They're betting about a 60% chance of a cut before Christmas.
Wow, still,
it got to about 80-85% about a week ago. It's come off a bit as the bond market sold off just in recent times, but it's still about a 60% chance of a cut, a 125 point cut in December. Then through 2025, we've got rounded. It's about 100 points of rate cuts through 2025. So we'll be ending if the market's correct. At the end of 2025, we'll have a cash rate at 3.35%, 100 basis points lower than today.
Well, sitting here today, and you can't, like it could be completely different in 2 months' time, but sitting here today, it's never wise for anyone to bet against the market.
It's tough, yes.
I mean, because they got the best information as of today.
And the markets are involving investors with billions of dollars buying and selling bank bills and bonds. And
they got more information than anybody.
Correct.
Anybody.
And the markets can change their mind too.
I'm saying today, though. I'm saying sitting
as of today, yes.
The money market's saying what you just said then,
Correct.
that we're looking at perhaps 100 basis points over the next 12 months.
Correct.
When Michelle Bullock gets out there and says, doesn't say anything and actually, in fact, sort of says, like she said in the last meeting, we were sort of considered putting rates up or leaving them the same, said nothing about putting rates down. Do you think that they take the same view as we would take? You don't bet against the money markets. The last time that happened was our previous governor bet against the markets and he got it extraordinarily wrong.
Yes.
In terms of his narrative.
No rate hikes till 2024, yes.
His narrative, because he would have known what the money market's saying. It's a dangerous thing for the Reserve Bank. It's a dangerous thing for the Reserve Bank to bet against the money markets, I think.
It is. They should pay a lot of attention and not be beholden to the money market.
No, different.
But to sort of say, well, what? And this is the thing that I often find interesting. I'm an economist, Mark, and I often look at the economy to work out what's going to happen to interest rates. Every now and then, in fact, more frequently as I'm getting older, I take a step back and say, what are the markets telling me about the economy? Why is the ASX at a record high today? What's it seeing that I can't see when I'm saying, gee, the economy's weak? What's the bond market telling me that they've got 4 rate cuts priced in when Michelle Bullock's saying, we're not going to cut rates anytime soon? What is happening? And that causes me to reflect on errors in my analysis or changes or something that I've overlooked. I've done, this, oh goodness, I forgot about that particular aspect. So I often look at them, and I think the Reserve Bank would be wise to do the same. Not, the markets are wrong, but to say, well, what's the market saying about the economy that we are missing when we are so dogmatic that we're not going to cut rates?
In terms of data, I agree.
In terms of data, yeah.
And we also know that money markets review their talk anyway, because money markets, if you remember this time last year, was saying we're going to get rate cuts in June. And in fact, Westpac was saying 7 rate reductions.
That's right, yes.
This time last year.
They were indeed.
For 2024.
Yep. And that was broadly priced into markets, if I remember correctly. So
it was, yeah.
Markets change the way, and they change on every snippet of news. So I can't remember what data's out in the US tonight, but when the US has a non-farm payrolls number or initial jobless claims and the US markets move, they're repricing on new information. Again, another Keynes quote, when the information changes, what do? I change my mind.
Yeah, which is, by the way, this is how the market works. So anyone who thinks they're getting brain damage from all this sort of stuff, that's the purpose of what we do, is actually to bring you up to date to today.
Yeah,
not beyond
where we are today. Yes,
we can only talk about, and the Reserve Bank only opines on what they know as of the day of their decision.
Correct.
And they probably would well accept, they maybe never say it, but if it dramatically changed the next day, they would dramatically change their position.
If I can just finish up on this one, Mark, I remember Glenn Stevens, the ex-RBA governor, when the global financial
One of the
crisis,
best.
He was great.
I think he was one of the best.
Agree. In the early stages of the global financial crisis in 2007, 8, that period, he gave a speech saying, inflation, and that's when inflation was a little elevated and they had hiking rates. We're going to have to hike interest rates again.
This is the beginning of 2008.
Yep.
The rates were quite high.
2 months later, after that really hawkish view on the economy,
August.
The shit hit the fan in the global financial crisis. The wheels fell off the stock
I remember
market. Data was falling. Banks were going belly up. He cut 50 basis points and said, I'm reacting to the new news.
Yeah.
No one said, you were wrong, because he acted so quickly and he was transparent about it.
Yeah.
He built his credibility, and I agree with you, as one of the best central bankers Australia's had.
Yeah, I totally. Kooky, thanks very much, mate. I'm getting excited. I just got a feeling of rate reductions, but anyway, not for this meeting. I'm coming up, and I think it's going to be 2025 anyway. Look, even if the money markets are corrected 60% chance before Christmas, and even if CBA is right, 25 basis point reduction in December this year, I think the RBA has gone so far out in a limb by making it so clear that they're not going to reduce rates this year. It'd be a very big call for her to turn back on that statement that she's already made.
Correct, unless they get one shock number, and we haven't had that.
And I don't think that's my view. I don't think we get. And you just said something very interesting about Glenn Stevens. We had the shock number.
We did. Oh yes. Lehman Brothers was. There was catastrophe in global markets, and the market said, "Thank goodness you're listening."
Yeah.
The markets was so happy, rather than him being dogmatic and I'm not going to change my mind. Holy smokes, he changed his mind when the facts changed for the worst.
Yeah, and
we got through that.
And I think in our
it wasn't painless, but we got through it
during the COVID period. I think sort of our previous governor, he sort of did the same thing too.
The way that policy, and even Josh Frydenberg with some of the fiscal stimulus measures. At the time when we thought unemployment was going to 15%, we thought we were in the worst GDP since the Great Depression of the 1930s. I don't think there was a policy mistake. In hindsight, you're saying, maybe they shouldn't have done this. No, at the time, it's a bit like fighting a fire. Should I really use all this water, or should I save water? No, you put out the bloody fire and then worry about it.
Yeah.
So both Philip Lowe at the RBA, Josh Frydenberg as treasurer at the time during the COVID pandemic, threw the kitchen sink at the problem. We got out of it, thank goodness. We got out of it in really good shape, the economy, that is.
Yep. We're probably too good a shape.
Maybe. But at the end of the day, I think what they did was broadly correct. It was correct. It was correct, And if they spend $1 too much, so be it. Take it back now. And if they cut too much, we'll hike a bit more, which is what they did, of course.
Which is what we've all got to be cognizant of. We are now still paying for the reactions and the overreaction as a result of the reactions to COVID. I mean, that was an extraordinary period.
Yes. We don't often, in fact, a lot of the analysis today doesn't actually refer back to that. And in fact, a lot of the hangover of COVID, both in terms of the inflation pressures.
Not just here, globally.
The inflation pressures, skills shortages, the current budget positions, all this sort of stuff is still being repaired, if that's the right word, from what was the medicine that was sort of dished out during the COVID pandemic to the economy. And that'll take another couple of years to sort of completely wash out of the system, and then we'll get back onto an even.
Do you ever think we're ever going to get back to, because we've suffered two sort of structural changes, which is, one was COVID, but prior to that was GFC. But do you ever think we'll get back to the days when you and I first met each other, when we know we would have 5 rate rises, 5 rate reductions over a nice long period. Then, then you have a lull, then you have a 6 up, 6 down, 5 up, 5, 6 down. It was sort of easy to predict. And we always had inflation around 2 to 3.
It got to 3.1, then it went to 2.5.
It was always in the category.
Went up to 2.
From 1996,
yes, it was extraordinary.
Right,
it was
to
extraordinary.
2020 sort of thing. It was.
There was a little odd blip up and down, whatever. But no, it was remarkable.
Do you think we'll ever get back to those sort of that rhythm?
Look, you've reminded me of a speech that the former governor Philip Lowe gave, a really good speech, where he said that the nature of economies now, artificial intelligence, technology, and even things like climate change are going to make the economy more volatile. So if you get another flood that washes out cabbages and lettuces and the price spikes up, what do you do about it? Then you get insurance premiums going up because the cost of insuring, property in Lismore is unaffordable now in the floodplains and all this sort of stuff. So I'm wondering that maybe we won't. Maybe we'll have like more intense moves up and down according to these shock events that come along every now and then.
Bit like the weather.
Yep.
Everything's more extreme.
Yep. And
hotter, colder, windier, stormier.
And the one thing that we should never forget is geopolitics. The events that are going on in Russia and Ukraine and the Middle East now, and
the China tension.
Taiwan's still there. We've got the US presidential election. I don't know what's happening there, other than it could be big.
Yeah, no, you're right. Actually,
I don't even know what direction.
We've never seen a US presidential elections being like this either. I mean, this is sort of a bit mental, and it's sort of like they're two extremes, two extreme individuals, totally different, and either one's probably not a good outcome. I'm just talking about economically. It's probably not a good outcome either way. And by the way, no one can predict what the net effects are going to be. It's quite interesting. The world has changed, mate. So maybe the answer to my question is no, we won't.
More volatility.
It's not going to come back that way. We're not going to have that lack of. We never had volatility before.
No, it's been a phenomenon since the GFC and then COVID.
Yeah, it's amazing. Thanks, mate. Talk soon.
Thanks, Mark. See you.